I'm rarely this late. I apologize. I am a little bit under the weather today. I will be drinking coffee to keep my eyes open, but happy to welcome to a new trading week. And let's take a quick peek at the futures. And what we're also going to talk about tonight is my prediction on the stock market moving forward. And it's not going to be, we're definitely going higher, we're definitely going lower. It's going to be a little bit more complicated. And as my father always says, he watches my live streams and videos. He says, you know what, just try to keep it a little bit simpler. And I want to try to using visuals. So let's talk about that. TrendSpider, link below, 35% discount code, our sponsor. I did a 5-part, my top 5 favorite stocks for the new trading week. I'm telling you, I'm under the weather today. That is posted on YouTube. It's also posted on the website. Members, I posted the price targets, the support levels for stop losses and entry points. It's in the members area. Go check it out. And what else? I think that's it. Let's get to it, man. Put the old spectacles on and go to the futures action. This is completely not set up. Normally I have these shooting ready to go. All right, so we have the S&Ps. Let's go to a 15-minute chart. S&Ps, a little bit of a gap down here. Let's change this. Okay, a little bit simpler. We left the day, to be fair here, we left the day overbought on Friday. So to get a pullback here, it shouldn't be a surprise to anyone. So S&P's down. Let's take a look at the Nasdaq 100. I have the Russell 2000 in front of me. So let's click that first. Russell 2000 gapping down as well, about the same as the S&Ps in terms of percentage move here. Let me check the comments, make sure everybody can hear me. All right, good. No complaints about it. I'll go to comments in a moment. I got to take this comment here. Larry, yeah, I had a crush on Anne Heche. There were a couple of really good movies she was in. I forget the name of the one that was with Ashton Kutcher. She played a really good role. So I had a little bit of a crush on her. So I'm really, really sad to see what happened. Yeah, obviously you're right. She had apparently a troubles, which led to her death. But very, very sad. Very sad to hear. Rest in peace, Anne Heche. Okay. And I'll go to the rest of the comments in a moment. Let's just get through the futures because I signed on late here. Let's take a look at the mid caps. Mid caps also moving lower. They're a little bit worse than the rest of the market here, down nearly a 0.25 percentage point. Where are my Nasdaqs? Here we go. Sizable move here on the Nasdaq, down just shy of a 0.25 percentage point. We're very early here, thin volume. So we really need to let these markets settle out before we draw any conclusions about what's going to happen tomorrow. If we have time, we'll circle back at the end of the commentary and we'll see how we do ultimately settle out here. Let's take a look at the drivers of the market. And primarily, and we're going to be talking about this quite a bit tonight, is the 10-year yield. Now, on a 15-minute chart, this is kind of significant for me, and I'll tell you why it's significant later on. You have yields that are dropping by about a 0.5 percentage point, and we've dropped down below the lower band of this consolidation range. Now, we did that last week. We bounced back into it, and we closed there. But just something to keep an eye on. One thing I do want to do here is I want to keep a very, very close eye on the 10-year yield. Moving on to, let's take a look at the dollar. The dollar's flat relative to its close on Friday. Overall, a good day for the dollar. The dollar was up along with gold and silver. Rarely do you see that absent geopolitical risk, but it was. Gold, initially, it looks as though it tried to push higher and it was rejected. And right now we are flashing a reversal bar. Let's create an alert. We closed out the week last week pretty much to the highs. It was a good week for gold, good week for our portfolio of silver stocks, gold stocks, etc. Okay, so that's set. Let's stick with the commodity trade here a little bit because again, we're going to be talking about tonight predictions about the stock market. All right, so we'll go to the drivers of the stock market because the stock market is not its own entity. It's certainly not the economy, although the politicians want you to believe that when it suits them. But we're going to talk about correlations quite a bit tonight. So, and causation. So stick around, a lot to go over tonight to come to an answer about mechanisms, triggers, etc., of what we're looking for to determine which way this market is going to go. Now, getting back to where's silver? Here's silver. Silver is up as well, but similar to gold in that we have a reversal bar at the open. Now, we do not have a new weekly high here. So what it's telling us is that it opened higher only to reverse and now reflecting a loss on the session in terms of the candlestick. Let's take a look at wheat prices. Normally what we do here is we take a look at the weekly chart to get a feel of the macro view, the higher level view for commodity prices, at least agriculture. So let's do that. Because if there's any one sector out there or space that really the trend is your friend, and it's commodities. Commodities, you get that trend going and you make a lot of money really, really quick if you get the directional play right. So we're consolidating here. We have stopped going down. That's rule number one to observe of anything that you're looking to buy that's been going through a horrible stretch of time, which we certainly have on wheat. We have stopped going down. We haven't put in a new weekly lower low. Actually, we put in one the week prior, but not on a real closing basis. It was back here in mid-July. So wheat is stabilizing. No breakout yet. Let's take a quick peek at soybeans. Again, I apologize for not having this ready in advance. Soybeans looking really, really good here. We are holding support. This is last week's price action in green. So this is not reflective of current price action today. A new bar will open up tomorrow. Corn. You could argue that we broke out last week. Let's just play conservative that we are at resistance on corn prices. So across the board here, what you're looking at is agriculture has stopped going down. The reprieve that we got over the past several weeks, several months, it appears as though that may be over. And we're settling in here for a period of consolidation. And with regard to corn, that consolidation may be over because if you draw your trend line down, it's clear that last week we saw a breakout. We do have resistance immediately above, but it's clear we have a breakout on corn prices. Let's take a quick peek at VIX. The VIX has been getting beat up really, really bad. Now, it's doing the inverse of what equities are doing. It gapped up. Now it's fading a little bit. It's actually doing, I apologize, it's doing the same as what equities are doing, except it's gapping up rather than gapping down. But it is fading like equities. Let's check out gasoline prices. Let's go to the macro view. They're stabilizing after several weeks of going down. Where's my home heating oil? Home heating oil. That's what I rely upon here. All right. Is it HG? I think it's HG. That's copper. God damn it. Well, let's take a look at copper. Dr. Copper. Still very weak. This to me looks like a bear flag setup. And we'll probably pull back. Do we break down to new lower lows, or do we put in a higher low, setting the stage for a rally? We don't know yet. All we know is that we want no part of it. It's not a good setup. I would avoid copper at current. The markets will tell us when it's time. Here we go. Home heating oil. I just saw, here we go. I got to tell my wife to get on the phone with the oil company. This is going up. This is going up. And, you know, the conversation we're having regarding these charts right now, folks, is going to come in handy later on when we talk about the direction of the overall stock market. So we have a breakout here on home heating oil. This is going to be very negative for the Northeast consumer and business. Let's go to comments. Tom, hello. How are you, sir? Seymour Rivers. Thank you. Yes. Glad to hear. Trader Isaac. Hello, sir. Jock. Welcome. Yoga Mac. I love a pullback. You're going to get one. You're going to get one. How's it going? Contrarian Crew. Awesome. New trading week. Back to work. Love it. I watched Donnie Brasco on Saturday. Great, great movie. Pete, hello. I have to say thank you who recommended HNRG. Okay, Tom. Shout out to those who are providing good trades. 6 days and 7 nights with Harrison Ford. Okay. Oh, she was in that movie? Anne Heche? It is a VMS play, moonshot potential. Okay. Hey, everyone. Hope you all doing well. Same to you, Devin. CPI, the dollar is driving stock prices. Metals have not yet responded to the dollar drop in kind. True, to a certain extent. True. Yeah, that would be. Well, the way you got to look at it in a way is that while the multinationals, what they sell overseas becomes cheaper, and that's a great thing because their profits increase. That's wonderful. The flip side to that is that as the dollar drops, guess what gets more expensive? All the commodities that I just went over here, to a lesser extent, natural gas, because we produce so much of it here, and imports. Another thing, we don't produce half of what you used to in this country. So all those imports that we've been giving those dollar IOUs for, they become all the more expensive for the average consumer. So yeah, good point in terms of, it's good for equities. Uh, Even technology. I mean, it was Microsoft, I think it was. It said their profit margins were being squeezed overseas because the dollar was so strong. So it's a valid point, but there is a flip side to that. It might sound crazy, but I'm curious about Bitcoin and the dollar correlation. We can take a look at that. Just remind me if I get too wrapped up and I forget. Can we look at gold? Yeah, we can look at gold. VXX were funky again last week, then popped after hours. Okay, good info. JD, thoughts on fertilizer stocks? It was a Mosaic. I think that's the only one I know. Used to have another one up in Canada, but they got bought out. Bob, I'm extremely confused with Etsy. It is more like a day trader's dream. Spread $7 in and out, extremely profitable. Is it true from your viewpoint? I don't know much about Etsy and trading it, so $7 spread between the bid and the ask. That sounds crazy. Is that what you made on the trade? If so, that's great. UEC is great setup, no chasing. Okay, Falcon. All right, let's get to it. All right. So, what to expect this new trading week? We have a lot of economic data coming out beginning on Monday. Empire State Manufacturing Index. We're going to get building permits. This is important because it's a leading indicator. Our contractors seeking permits. There's an expectation for 1.7 million. If that misses, that could be a problem due to the fact that, especially with housing starts, if they miss as well, the ripple effect of construction on the U.S. economy is profound. So if you see a drop in building permits, it's forward-looking. Housing starts, that's in the rearview mirror. If both drop, that is not good. Industrial production, capacity utilization, retail sales come out this week. Big number. It's probably going to be a decent number. Why? The consumer credit last week, I think it was last week, if memory serves, it blew through the roof. Maybe it was the week before. Yeah, it's not showing up here. But it was like a 30% beat to the upside. It was ridiculous. And people were spending it not on products, durable goods. They were spending it at the grocery store. What else do we have? Philly Fed Manufacturing Index. That comes out on the 18th. Leading economic indicators. You have a couple of Fed heads coming out this week. Neil Kashkari, he's adopted. He's one of the most dovish guys on the Fed, but recently he's taken on a more hawkish tone. So for him, he's a wild card. You got Barkin coming out on Friday, Esther George coming out. So when these people take to the podium, there's an agenda, there's a narrative they're going to spin. So let's just keep an eye on what they have to say. The headline risk is going to be out there this week. All right. In terms of where we're at, in terms of valuation, this is not a cheap market. It's a very expensive market. So the Schiller PE ratio is at 32 again. And it's moving to the upside. The mean historical 16.97. So that gives you a picture of where we're at in terms of the valuation of the market. For the most part, earnings season is out, done. You have a few big reports coming out, not much, but this is where we're at in the current earnings picture. So it's a current snapshot. And it's going to be forward-looking for the next 3 months until we get new earnings. Buffett indicated we remain, as we did last week, overvalued by 45% beyond the historical trend here. So there's a lot of narrative spinning going on out there about equities and we're in a new bull market. We're not in a recession. Everybody wants to attack the truth. They want to redefine truth. Okay. Don't let them take parking space up in your head. Equities are not cheap. They are not cheap by any stretch of the imagination. So, as we talk about forward looking, where's the market heading? This is a problem. This is a serious problem. So they're going to keep building this market back up higher. I personally believe that they're going to pull it back early this week. They're going to retest a couple of breakout points, and then we're probably going to drift up higher. Some people took issue with me. And I want to clarify this. I mentioned last week that I had put on hedges. That does not make me short of the stock market. I trade a lot of options. We have cash flow strategies that we use. We continue to do those. But the problem with those strategies is that at any given time, I have undefined risk that if we see a binary event in the stock market, meaning you see the Dow drop by 1,000 points, a flash crash, I would have a lot of problems. I would have serious problems. So I need a safety net because I don't trust the current market environment. So I am not net short. I got a comment the other day on YouTube. A guy's telling me you're shorting the market. You're going to go chapter 11. And what I interpreted into that is that, okay, here we go. We have a guy that watched the video. Fine, great. He's seeking information, but I challenged his narrative. He heard what he wanted to hear. I was bearish on the market, which I was not. I'm frankly bullish on the market right now. But what he heard pissed him off because he is too emotionally wed to his positions. He's married to it. He's invested, not just financially, he's invested ego-wise, and he doesn't want his ego challenged. If that's the way folks are trading out there, you're going to get hit. You're going to get hit really, really hard. If you're thinking like that, you're taking too much risk. Your positions are too big. You're too wide on margin. Be careful. Be very, very careful because this is the market that we're in. I don't make it up. This is the way it is. Okay. And we're going to talk about some optimistic things and we're going to talk about some pessimistic things. And yes, there are more pessimistic things out there than there are optimistic because nobody in Washington wants to do the right thing. And when they do the right thing, unfortunately, it ain't stock market friendly. Earnings this week. All right, so we did a bunch of earnings trades last week. Net. We had a good week. We had a couple of problem children we dealt with. We traded around. So we had a very good week last week. This coming week, we don't have much in terms of earnings trades. I see a couple of Chinese stocks here. Folks, you got to avoid these Chinese stocks. You have to. Please, I beg of you, avoid them. I make it a point. I won't even buy ETFs with Chinese stocks that have a big position like the EDC. I won't buy it because China makes up 30% of that ETF. So a lot of Chinese stocks, I will not trade them. Home Depot coming out, Walmart coming out, we can trade those. Target will definitely be trading, very high implied volatility, maybe lows. Cisco, you don't get much in terms of premium on Cisco. We'll take a look at it. They're not building up premiums. They're not expanding out the value of options like we want to. When you go into earnings season this quarter, that's just the way it is at times. Volatility has come in. That makes it a little bit tougher on these earnings trades to make a buck. But we work around it and we still make money. But we got to worry about our risk. Kohl's, not much. A lot of retail coming out this week. Not the best premium pairs. AMAT's coming out. That's a possibility. But again, they don't pay them a lot on those options in terms of premium. And for those folks that aren't familiar with what the heck I'm talking about premium, we are option premium sellers. We do not buy the options necessarily if we don't have to, unless we see a great directional bet. But otherwise, 9 times out of 10, we sell premium. We like to be the casino and not the gambler. Although we take undefined risk, and sometimes one particular trade, we can be the gambler. So even the casino loses sometimes. All right, so risks that are continuing to happen here. Over this weekend, U.S. lawmakers land in Taiwan for an unannounced 12-day trip after Pelosi visit. Nothing good can come from this. Nothing good. But we continue to want to poke China in the eye, and it's all about provocation. We're seeking provocation. I can't think that there's anything else behind this than we're seeking provocation. Whenever you have a government that is completely and utterly unpopular, as we have right now, what do? They go to war because they need to stoke nationalism. I think that most people, they'll look at this and say, what are you doing? What are you out of your mind? And they're seeing, people are beginning to see, even the normies. So the fact that they're doing this is very obvious. They want a war. They want a conflict. They want another Russia. That's another reason why you need to avoid Chinese stocks, because Russian stocks, I have RSX in my portfolio. I've been looking at it since the Russian invasion, right? Their options, they're going to expire soon. Eventually, they'll drop off. It's a small position, but it's worthless. It's been worthless for months. So I'm not going to take that risk with Chinese stocks. So believe me, I speak from what my experience. So avoid these Chinese stocks for many reasons, not just the U.S. government. Here's another reason to avoid Chinese stocks. 5 Chinese U.S. listed giants announced delisting plans over audits. So the Chinese stocks are not held to the same accounting standards as U.S. stocks. You may find this shocking, but it's the reality. And because we want to audit them, now they're threatening to delist. Sayonara, get out of here. We need clean markets. The problem is that a lot of people aren't going to know it until the last minute, and they're going to get burned. So you're talking about names like Alibaba, Baidu, all these names. About 300 businesses based in China and Hong Kong with over $2.4 trillion in market value risk being kicked off U.S. exchanges as the SEC increases scrutiny on the firms. Bloomberg Intelligence estimated in May among the business biggest are China Life, PetroChina, China Petroleum and Chemical, Alibaba, Baidu. Nothing good can come from this for the U.S. unless you're going to short in advance of this occurring. Nothing good can come from for the U.S. investor. More Taiwan fun. More China. China. War. Russia. All right. So this is the narrative. All right. This is being force-fed down us. Taiwan tensions speed up U.S.-China decoupling. All right. So this is just a bullet point out there that, yes, we are seeing a widening out of relationships. What does that mean for the supply chain? It ain't good. Now, the narrative is very, very dangerous. It's extremely dangerous because it lures people into a false sense of security. Now, when you have this guy come out and let him speak for himself.
I just want to say a number. 0. Today we received news that our economy had 0.
Hold on, I want to replay that.
We received news to the economy. Actually, I just want to say a number. 0. Today we received news that our economy had 0% inflation in the month of July. 0%. Here's what that means. While the price of some things went up last month, the price of other things went down by the same amount.
All right. The level of dishonesty here it's off the charts even for a politician. The reality is that you could take month over month numbers and do what you want with them. Year over year, let's go to it. Where is it? Where is it? Where's last week's data? Here we go. Okay. So here's what he's talking about. He's taking this one little bullet point here. This itsy bitsy thing here. We knew that this was going to be a very weak number. I was saying it. I am recording this from my basement. I do not have a degree like Paul Krugman in economics. It doesn't take one to make the right decisions. Unlike Paul Krugman, we have been able to call this market to the T in terms of what the CPI should be expected for the month of July, because we knew what was driving the headline number. The headline number is being driven by energy prices and food prices. But conveniently, the Federal Reserve doesn't pay attention to that. They look at this number here, the core, that backs out food and energy prices. And at the core, month over month, inflation still increased. Year over year, 8.5% inflation. At the core, 5.9%. And this is using rigged numbers. This is not using actual rents. They use what you call owner equivalent rent. Basically, they call up a home owner and they say, hey, what do you think you could get for rent of an apartment or your home? And they throw out a number. It's below the actual market. And that's what they hang their hat on. They don't call up landlord and say, hey, listen, how much did you jack up rents this year? They don't do that. Owner equivalent rent, because they don't want the real numbers. It hurts too much. Moving on. So we know that energy prices have come down, but you have a hurricane brewing off of down by the Gulf. You have another, this is unrelated, 600,000 barrels of oil output shut at 7 U.S. Gulf platforms on pipeline outage. This is as of Friday, 6 a.m. Grocery inflation hits highest level in 43 years despite Biden's inflation messaging. Here we go. In monthly and annual terms, some of the sharpest year-over-year jumps in food purchased for consumption at home include flour, up 22.7%, chicken, up 17.6%, milk, 15.6%, bread, 13.7%, eggs, 38%, 38%. And even though the overall month-over-month CPI index growth came in at 0, the vast majority of food at-home items that make up the index also saw month-over-month increases, including potatoes, food staple, coffee, staple for me, peanut butter, chicken, and eggs. The cost of shelter, and this is what I referenced earlier, the cost of shelter also rose in both annual and monthly terms, climbing 5.7% over the year and 0.6% over the month. The so-called core CPI inflation measures, which exclude food and energy, which I mentioned, and is viewed as a better gauge of underlying price pressures, remained unchanged in July at 5.9% in annual terms and up 0.3% in monthly terms. Sorry to be redundant. We've already gone over that. The fact that core CPI rose over the month suggests inflation could stick around. That's the key, the sticky factor of inflation. The Federal Reserve has used jargon that they want 2% inflation growth. What they tried to do in the beginning, when inflation was transitory, they were going to manipulate prices down. That's never going to happen. It's never going to happen. Landlords, especially after the rent moratorium and they're making up money that they lost, they're never going to reduce rents, ever, especially now. So inflation is real. It's not at 0 as the politicians might want you to believe, because they think that we are stupid. Now, last week we had a nice rally in the market. UMISH sentiment survey jumps, but long-term inflation expectations unexpectedly rise. I want to focus on the UMISH for a minute, because it is the proximate cause of as to why we saw, along with the CPI report, came down month over month. No big deal. I would argue that these are not catalysts to send the market up higher for any length of time. Why is that? Is because while we saw a pause in the month, the year-over-year inflation rate remains higher. And we're going to go to some charts in a moment that are going to show you how we've actually begun to tick back up on commodity prices, but not enough to adversely impact the stock market yet. The yield curve. Now, I've been coming on, I share this usually every Sunday. We talk about it, maybe on Thursday nights as well. For those not familiar, the yield curve is predicted every recession since 1955, with the exception of one. These gray areas here indicate where you've seen an inverted yield curve. That does not mean go sell your stocks. When it flattens out, it does not mean go sell your stocks. When you start getting nervous is when you get an inversion of, excuse me, a steepening of the yield curve. Now, the steepening is when you begin to get a normalization of yields. The problem is that's not good for equities. Traditionally, equities, at least in recent years anyway, they roll over. So what we did last week on the yield curve, after weeks of going down, declining, we closed up. So 1 week does not make a trend. So this is not doom and gloom. It's 1 week. I mean, back here, we saw a steepening, then it rolled over, it fell out of bed. For all I know, that's going to happen again. So this is not a setup where the yield curve, a commodity or something I could buy as a long. Do I see a setup for this moving up higher besides the fact that it's oversold? No. But the point of the matter is that we have stopped going down for now anyway. It's only 1 week. We will continue to watch it very, very closely, because if this begins to pick up steam and we begin to break out to new higher highs, that's when you need to get worried about equities, because there's something out there. The yield curve was inverting before COVID hit. Then COVID hit and equities went down like this. The great financial crisis, it was stable, yield curve inverted, stocks went like this after it began to steepen. So this is out there. To me, when we talk about stock market prediction, 99 times out of 100, you have a normal steepening yield curve, albeit gradual. When this thing goes inverted and then begins to normalize at a rapid pace, it's generally not bullish for equities. And arguably, if you go back to 2000, it's very, very bearish, because things get real fast. And just to illustrate, going back to this UMISH, I'm out of sequence here. UMISH came out, nice pop-up higher, but I want to point out, this is no reason to go jumping in and buying stocks. How do I know that? Am I not Paul Krugman? You should listen to Paul Krugman. He's got a PhD. Although he's a communist, he does have a Nobel Prize. But when you take a look at the correlation of, and this is a monthly chart, so there's a lot of data here. When you look at the correlation of the University Sentiment Survey relative to the S&P 500, it's negative. It's a blip on the screen. So to think that a rally off of the lows is a reason to go out and start buying stocks, I would argue that you don't want to do that. That's a bad move. Take that argument, throw it out. Now, what we're looking at here is the yield curve over here, yield curve in Candlestick, and then we have the correlation to the S&P 500. And you can see that when we begin to, excuse me, yields. I apologize, yields. I was confusing myself. These are the yields, not the yield curve. Yields begin to pick up. It's not good for equities. And the reason is this, is that back in 2000, we were a capitalistic society. But after 2000, you had the Fed intervention so much in the economy, we became a creditor society. So every time the Federal Reserve changes policy, has an adverse impact or positive impact on equities. It's the Federal Reserve that drives the stock market. Have no doubt about it. The problem for the Federal Reserve, which they're fighting right now, is that they're backed into a corner. For years, they had little to no inflation to worry about. Nominal. I'm not going to even argue it. Nominal inflation to worry about. That gave them a lot of room to be able to keep yields pretty much at zero. What did that mean for equities? Well, they rose. Plenty of capital out there, expansion, boom times, GDP ripping through the ceiling, all good stuff for equities. The problem is that if you take a look at their balance sheet, which we're going to in a moment, it's not going up higher anymore. And I'll show you some specific data points to show you how correlated equities are with the Fed's balance sheet. Now here's the S&P 500. And there's a reason why I'm going over this, folks. And let me tee the ball up here for you a little bit. As yields rally, it does not mean that equities cannot move up higher. The problem is that once you reach a certain level, meaning a 3.5 handle, 3 handle, 3.6 handle, 4 handle, I don't know what it's going to be, but it's been since 2018 around that 3.4 handle. That's when things get really, really rough for equities. And what this chart is showing right now is that as this is relative performance of the S&P 500 versus the 10-year yield. And up here is the 10-year yield. Basically, 10-year yield goes down. Here's the S&P 500. The stock market goes up. Same deal here. We saw yields begin to creep up, but stocks kept going up higher. The problem is we reached that 3.4 handle on the 10-year yield, and all of a sudden, everything locked up. And the stock market did not like it. And equities, meaning high-tech, beta stocks in particular, took it on the chin. The small caps, they were in a downtrend well before the triple Qs topped out by like 6 months to 8 months. So yields matter. The point of the matter is that yields matter. So the question is, when we talk about stock market performance moving into the back half of 2022, what are yields doing? And what are driving yields? That's a simple question. So I can't tell you. I'm not going to be Tom Lee or one of these CNBC slick-back salesmen coming to talk my book because I'm a hedge fund manager. I'm not going to do that. My answer to you is, on a technical basis, the stock market looks like it's going to go up higher. It was a good week technically, a massive breakout last week. Do I think we're going to pull back this week? Yes, I do. Do I think that we're probably going to hold support levels? Quite probably, with the exception of one thing. And I'll go to that in a moment. Let's stick with, because I want people to appreciate, get some value out of the correlation of yields relative to stocks. If you appreciate that, you don't need me. You certainly don't need CNBC. If you know the correlation of what's influencing stocks relative to the yield, then you'll be fine by yourself. When you take a look at the Qs, this is simply a daily chart. And what we're going to do is we're going to go back and we're going to take a look at the Fed's balance sheet. So let's go back here. Let's choose this date, November the 22nd of 2021. Bearish key reversal bar, 5-part video tutorial below, free. My top 5 favorite candlestick patterns. Take advantage of it. No charge. My gift to you. Bearish key reversal bar, very negative for equities. What could have happened during that time frame to potentially influence this bearish event? I don't know. Let's go over to the Fed's balance sheet. What date was that? November the 22nd of 21. Oh, look at that. When the Fed's balance sheet was reported on the 24th, that marked the peak for the next couple of months because the Fed's balance sheet dropped down. Fast forward. Let's go back to the very same chart. We consolidated. Why? After a sell-off, the Fed's balance sheet consolidated. Then we rallied. The problem this time is that we couldn't take out prior highs. It was a double top. This was the death knell for equities. Why did this happen? Why did we flash this reversal bar and go into a downtrend, break down to new lower lows, and find ourselves in the current bear market for which we are in? Let's take a look at the Fed's balance sheet. December 22nd, 2021, Fed's balance sheet is reported. That marks the peak of the Fed's balance sheet. It declines. What date was this? Immediately thereafter, the 28th. The peak on the Fed's balance sheet was the 21st. So the point of the matter is, I could go over this over and over and over again. There's a direct correlation between the Fed's balance sheet and the stock market. There's a direct correlation between yields and the stock market. Not always. If the yields are low and they're coming off of ridiculously low levels from 0.5% to 1%, equities could do just fine. That's cheap money. Now we're talking about on the 10-year yield, 3.4, even a 3 handle. That's a problem. So this chart here is a monthly chart of the 10-year yield. And all we're doing here is we're saying, okay, the title of this video is Stock Market Prediction for 2022. To give you that prediction, which could change day by day, I need to know what the 10-year yield is doing at any given moment. Because we know, going back to 2018 right here, we know we get into this range up here, equities roll over. So what are we doing? We've seen several weeks of downward move on the 10-year yield. What did that cause? Stock market rally. Yay! Inflation's gone, according to the politicians. We don't need to worry anymore. It's all good. Until you realize that after breaking down below a support level last month, now this is a monthly chart, several trading days left to go. A lot can happen. We could sell off here. So we're not drawing a conclusion. We're making an observation. And we want to adjust portfolios accordingly so we are rewarded for our risk appropriately. And we are not hit over the head because we're ignoring important data. Now, when you take a look at this chart on a monthly time frame, we broke out. We have broken out. We have not closed there yet, but at current, we have recaptured support. But I'm going to go to a chart in a moment that's going to be a little bit more alarming. So what influences the 10-year yield? Well, the cost of goods, right? You see, this is the DBA. This is basically food prices. After a long sell-off here, several weeks of a sell-off, what have we been doing? Well, we've been rallying. Does this mean we rally straight up and take out prior highs? Can't make that determination. If we pull back and we put in a higher low and we break out to new higher highs, then this becomes a serious bullseye for traders to tackle. And if we do break out above this higher high here, you could bet your bottom dollar the 10-year yield is going to be ripping through the ceiling because the Federal Reserve has just been served notice. You had better jack up rates because the bond market is demanding it. They're pricing it in. The Bloomberg Commodity Index. What's it been doing after a long downtrend? If you overlay the S&P 500 here, you would see this is where the S&P's bottomed, right where the commodity index peaked out, and now we have stopped going down. Last week was a good week. Equities shrugged it off because really this is not a great chart. We could quite possibly be in a bear flag setup. I would not buy this personally right now. It's at a resistance level right here at around 37. I don't see the setup. So I'm not ready to draw the conclusion that because commodity prices rallied last week, that we're ready to see a considerable move higher in yields, therefore a rollover on equities. Oil prices. Remember, go back to this number. our esteemed, the venerable commander-in-chief, he said that we have zero. I played the video. Zero CPI for the month of July. How does that change? Well, how it changes is simple. West Texas Intermediate crude. Remember, we have a hurricane coming and 600,000 barrels have just come offline. Back to the chart. We are at the lower band of the declining downtrend channel on crude prices. If we break out and close above $95 a barrel on light sweet crude, guess where we're going? Up. Natural gas. We will be trading natural gas. Members, we're going to be putting on a strangle trade on natural gas using Boyle tomorrow. It's already teed in. I already have it locked into the system. So I'll share that with you later on. Natural gas. Overlaid here with in gray are the peaks in natural gas. We have seen a nice healthy pullback, but folks, this is like a V-shaped recovery for natural gas. So while in late June and into July, natural gas prices, I need more coffee. Natural gas prices saw a decline. Guess where we're at? We're back up to the highs of June of 2013. Guess what's not calculated into this number? The rally back on natural gas. That will be in next month's number. Now, oil prices are still low, so it's not going to be a shock on the headline. Now, the chart that has me concerned is this one here. I mentioned earlier that the 10-year yield monthly time frame, we have a breakout, but it doesn't necessarily mean we're going to close there. We have several trading days left to go. So we trade the market that we have, not the one we want. So what's the market that we have? Well, this chart here is a weekly chart of the 10-year yield. Last week is now in the books, and we broke out. Not only did we break out, we had pulled back, retested key support, and then rallied off of it to close up on the week. This is a bullish chart. If I had to hazard a guess, it looks as though we are probably moving up higher on yields. And when you take a look at a yearly chart, if you can believe it, we have less than 4 months left in the year. And when you take a look at the yearly chart of the 10-year yield, and I'm not saying we're going to close here or higher. Maybe we'll close negative for all I know. I'm not that smart. But what the chart is telling me right here, right now, in this snapshot in time, on a yearly time frame, we have broken out on the 10-year yield. We haven't had a yearly breakout on the 10-year yield since the 70s. And just to really drive home the relationship between the stock market and I'll share this with you. There's a lot going on here, but it's pretty simple. Here's all the QE programs. In black, you have the S&P 500. What we've gone over as well is the Fed's balance sheet in blue. And you could see that by and large, the S&P 500 and the Fed's balance sheet are lockstep. When the Fed's balance sheet rolls over, the stock market rolls over. Even when they pause, they haven't really reduced the size of their balance sheet all that much, by a few $1 billion. But the stock market is taking a header. So what happens if they hold true? If they really hold true, now they've moved to September, that's going to be the month where they get serious. They're going to reduce their balance sheet. Okay, we heard that about June, July, August. Really didn't happen. But the trend on their balance sheet is, if nothing else, I'll give them, is clearly down. Lower highs, lower lows. It did increase last week. God bless their honorable souls. But even when the Fed's balance sheet flattens out, it's not enough rocket fuel for the stock market. So I want to leave off here with a positive. Okay. I mentioned earlier that, back in 2018, it was about a 3.4 handle, 3.5 handle. That's when everything seized up. I mean, locked up. But keep in mind that since 2018, we have a ton more debt than we did back in 2018. About nearly $10 trillion more. To be fair, a little bit less than that because we locked up late in it was November, December of 2018. And then we crashed. So here we are up here. You would have to, and I'll be honest with you, I've been puzzled as to why the stock market, with all the additional debt relative to 2018, has made it up to a 3 handle and not really collapsed. It's gone into a horrible correction. Yeah, bear market. Yeah. But why it really hasn't just fallen apart. And the reason is this, and this is why there may be a little bit more room to the upside for the equity market, even if yields rise somewhat. I'm not going to give it a lot of room here. But when you adjust the debt relative to GDP, debt from 2021 has flatlined relative to GDP. In real terms or nominal terms, it is higher, but relative to GDP, it's flattened out. So that's why I think that we could have a little bit more room to the upside for equities to continue to rally here. But is it going to be 3.4, 3.7, 4%? I don't know. We can get there very, very quickly. Therefore, we want to have our safety nets out there to protect us just in case this market goes the opposite direction. Because I know for a fact I have not sounded bullish about where equities are heading longer term than tonight, even though I think that shorter term we have more melt up here. But I'll say this: watch the Fed's balance sheet in September. If they hold true to even a fraction of what they've said they're going to do, if you see lower lows into the month of September, I don't think the stock market holds up. It's a managed stock market. It's not real. It's not driven by manufacturing and sales. It's not. It's simply not. It's manipulated by cheap money, and I didn't make it up. I don't want it. I would love to see normalized economy. I would love to see a return to the truth and not changing what a recession is. I mean, I'm looking at article after article. They're saying that we're in a technical recession. No, we're in a technical recession. Just because some politician changes the definition of recession doesn't mean I put my stupid cap on. We're in recession. So let's go do some comments here. I've talked a lot. Biden is lying every time his lips move. Very, very true. You guys like the Tom Lou's got some trades out there. Mark Zuckerberg, I live by you. I saw your email on the site. Are you still single? My name is Susan Wojcicki. Man. Rich girl at the street. Maybe we have some messaging on tonight. Rumor this week on news, but do not extend yourself. I feel. All right, HNRG, you love that stock, huh? Any opinion on short? Nah, I wouldn't short it here. No, I wouldn't short it. In fact, I have an SQQQ position on. Let's go to the SQQQ for a moment. Actually, let's go to the Qs. No, I would not short here. Definitely not. And again, this goes back to what's the market that we have. The market we have is one that wants to go up at current. Now, last week, we closed above the upper band of a downtrend channel. You can't short it here. I think that we could retrace back down to 320. If that fails, if it fails and we break and close back down below, let's call it 315, it's a short all day long. But right now, no, it's definitely not a short. So if I may take off the SQQQ trade. I think Seymour Rivers asked me the question in the comment today on YouTube. Yes, I'm still in the trade. It's not a big trade. It's a hedge trade, a little bit of speculation. As a matter of fact, I had it this time last week. We sold it on a rally, made a profit, bought back in after the CPI report, and just we got a lot cheaper than what we sold it. So we're back in on it, but cheaper prices. We're not holding it at the prior price that we bought it at. We sold it, bought back in. So if we hold support next week, I'll probably take that trade, take it off the table. I will definitely not be adding to it until we head up here. I will speculate to the short side once we get the Qs. And the reason why I'm using the Qs and not the S&P 500, the Qs are far more sensitive to rising interest rates because they're technology, a lot of high beta there. So a rally up into 344 would have me speculating to the short side. Yet again, if we close above it, I stop out, take a small loss. But that's the game plan there. Michael Burry says we might dip again S&P 500 to 348 by mid-October before next earnings. What do you think? I think that it goes back to our train. It goes back to what are yields doing? What's the Fed's balance sheet doing? Simple as that. You know, if there's anything that I would ask that anybody pull away from this conversation tonight is that you take a look at the charts I went over, and you take a look at, you know, there haven't been many times since 2000 where the Federal Reserve has been aggressive with raising rates. You only have a couple of snapshots in time. 2015 to 2018, they raised rates only a few times, rolled off some debt off the balance sheet. The stock market collapsed in 2018. We had the same earlier in the year. Now the Fed, they're not being aggressive as they promised to be with rolling off debt off the balance sheet. Yields pulled back, commodities pulled back. That allowed equities to rally. I just showed you the charts that are influencing yields, which is oil, food prices. They are beginning to creep back up again. What does that mean for the 10-year yield? It's going to go up again because bond owners, or those who are buying our bonds, they want to get paid a yield. They want to get paid for the risk they're taking on for loaning money. Oh, I got monkeypox in the money. Loaning money to a country that changes the definition of recession. Men have babies now. I mean, this nonsense, this crackpockery that we live in this country right now. It's a basket case. We have a president out there saying that there's 0% inflation. Zero. I want to begin this press conference by saying there wasn't even a press conference because he didn't take questions. Zero inflation. Zero. This is what we're in. This is delusion land. Oh, it's not delusion. It's nefarious. It's nefarious is a better word. Falcon, watch Lowe's earnings and see if what I saw last week, Val, I was thinking about you. I saw that. I remember your comment about that. We'll keep an eye on it. I only want my mortgage debt. Yep. Only debt you would want. Except in the Northeast, because now you have a cap on the amount of interest you could write off. 5K S&P 500, Dow 40,000, 20,000 Nasdaq coming. Okay. Takes two to make a market. They're sickos, Bob. Yeah, they are. They're demons. They are real demons. Bitcoin. Yep. Thank you, Yoga Mac. So Yoga Mac wants to know what's the correlation between Bitcoin and the US dollar. Where's my Bitcoin? B, Bob. B. There you go. Negative correlation. It's really, this is a great observation because the dollar really had a rough week last week. Bitcoin was up. If the dollar breaks, that should be very, very good for Bitcoin. Interesting. We're going to watch this one. Thanks, Yoga Mac. So, for those not familiar, if you're wondering what we're talking about here, in short, what this chart is telling us, this graph here is telling us that there's an inverse relationship between the US dollar and Bitcoin, and that if we see a breakdown on the US dollar, that we might just see a rally in Bitcoin. To be fair, though, there are points in time. Let's go back and use a monthly chart to smooth this noise out, where you've had positive correlations. All right, but at this snapshot in time, this market that we're trading in right now, there's an inverse correlation with Bitcoin. So if I had to make the trade, if the dollar breaks, I'd be a buyer of Bitcoin, no doubt about it. But if Bitcoin doesn't follow through, it breaks down with the US dollar, obviously it's a bad trade. You got to exit. So good one, Yoga Mac. Just joined. I'm a little confused at how market is doing. Can't make very good options trades lately. Are you selling premium or buying premium? Oh, we have a comment from Twitch. I'm going long for now. Okay. Just know your exit point. That's all. Bob, my wife is an experienced trader. I am learning. Cool. What does she trade? TZ Burton. Hey, Pat. Welcome. Welcome. Saw the photo of you and your grandson. Very handsome. Hope all is well with you. Like and subscribe. Yes, please. Thank you, Yoga Mac. Please like, subscribe, comment. If you disagree with me, agree with me. If you're going to disagree with me, just leave a comment as to why. I'm fine with debate. I love debate. But when people make stupid comments, it's just like, grow up. If if you're making a comment, ask yourself the question: am I writing this out of emotion because he's talking against my portfolio? Just think about it a little bit. You bet, pal. Pat, PLTR was a bust on earnings, but AAL and BA look okay, and AMD. Okay. Buying premiums. Okay, so you should be getting some good deals on options. Options are cheap right now. I mean, you take a look at the triple Qs. The only reason why I bought premium on the Qs as a hedge was, I'm worried about the market, but really, what really influenced me was that you have implied volatility that closed out on Friday on the Qs at 21%. That's cheap. That's dirt. So if you're going to choose a time to buy premium, now is the time in either direction on the Qs. You're probably going to have a little bit of call skew on pricing, but it's right now, and you get a deal on the puts right now. But I went out until, what did I go out? 2023. I forget what month I went out. Way, way, way out. I have like no theta decay right now. AMD, nice move. Let's see, continue. I think we traded AMD on earnings. Six mostly tech stocks. Gotcha. Yeah, I know, Pat. You like selling premium like me. Yeah. Yep. Yeah. Right now it's a little bit challenging to find, even with earnings trades. You're not seeing earnings trades come around with 80-90% high implied volatility. Target right now is a great opportunity. They're reporting earnings this coming week. High implied volatility. I'll definitely be involved with that trade. Probably short term and long term, going out about 45, maybe 50 days. And I'll trade the weeklies as well. AMC moved nicely last week. Yeah, that's always a big premium pair. But you know what that does? If you're that eats up a lot of buying power. So I really don't trade the meme stocks per se, because your return on capital, it could be very inconsistent. So that's what worries me about those trades. All right, let's do some chart requests. We'll do an AMD for Pat. Where are we at in time? Oh, wow, we're over. AMD. Again, folks, I did my top 5 stocks for the new trading week. I think actually 2 of them are ETFs. So it's on YouTube. It's also on the website. Advanced Micro closed out the week last week into resistance. It looks like it wants to break out here. The semi stocks looked really. In fact, one of my top 5 picks for next week is the SMH. Semis look very good. Folks, we're using TrendSpider here, automated technical analysis, 35% discount code below. Get your own automated software, your own AI, I should say. Believe me, they're selling a lot of these subscriptions. So the people next door to you, in terms of the retail trader, they're using this more and more. So again, 35% discount code below. Weekly breakout. So this is one where we might trade it. Looking for a weekly breakout. AMD looking good. Daily view. Yeah, you have a lot of overhead supply here. Here's my manual line drawn in green, and here's the automated trend line. Let's take off mine. You can see this is the algorithm. Now, if we break out above this resistance level here, these prior resistance levels become resistance levels yet again. So we need to get past, what's this price here? 10, let's call it 103. And we close above that mark. AMD becomes a buy. And it looks like it has a lot of upside potential here. I'm liking AMD on a breakout. BA. Let's go to the oh, I have some members requests to go over. Israel. Okay. Gotta check. BA is looking good on a weekly time frame. It's an outside week last week. The daily chart, this is the value of having the automated trend lines. I mean, take them off. Looks like it wants to go, and I might even have bought this, but appreciating where there's resistance above by clicking a button. We broke out on the 10th, failed to hold on the 11th. Now we closed right at resistance on the 12th. I would wait for a breakout above resistance on Boeing before adding more to the trade or opening a trade. Visa. Visa weekly chart. You have a nice consolidation here. We've stopped going down. What I always like to say is the longer the consolidation, the greater the validation of any breakout. And what we have here is a resistance level that I already have up here. I would be a buyer of the stock on a breakout above resistance here. Set up our alert. Selling puts, we sell puts. People hear that, they think it's a bearish trade. When we sell them, we're bullish on the stock. When you buy them, you are bearish. We don't want any sensitivity. Our alert is set. The price target to watch here is $219 per share on Visa. A close on a weekly time frame above that mark makes it a buy. Now, on a daily chart, you really got to wait for that breakout because it's struggling here. This is a bit of a triangle formation. We have several consecutive days here of down price action. Not wonderful. RSI is rising, stochastics are rising. These are your forward-looking momentum indicators. Those are positives. So Visa's firming up here, weekly time frame. It's backing and filling on a daily time frame. Would I buy it here? No. Would I sell premium? Meaning, would I sell a deep out of the money call, deep out of the money put? Absolutely, assuming that you can get paid enough premium. I doubt it's out there. Let's see what the options are trading right now, the historical implied volatility. Yeah, these are options you got to buy. The options are, and for those not familiar with what we're looking at here, the line we're focusing, forget about everything else. Forget everything else. The only line that we're looking at here is this one, current IV percentile. What that is a measure of is the relative cost of the options over a 52-week period. So if you have a read below 50, that is an option that is deemed to be fairly valued or cheap. Obviously, if you're at 11%, that's pretty cheap. You're not going to get much lower than that. So if the chart looks bullish, I would be right now, if I think that it's going to break out on a weekly time frame, you want to speculate, well, you could buy a deep in the money call option and then sell a deep out of the money call option to help finance that trade. So that's one way to play it, or you can just simply buy the options outright with no hedge on, or if you're really confident and you really definitely think it's going to go up, sell a naked put, buy the call. You finance it with that naked put. That's very high risk, though. It's a high directional bet, so that's not one I would recommend unless you have inside information. But the options here are very cheap. Let's go to comments because I'm blabbering on. You're welcome, Pat. We are past earnings, not as much premium. Yeah, there wasn't as much premium during earnings. It was really, really crazy. A few stocks had premium, but not many. It was very disappointing. We could have done well. I mean, we did well. We could have done a lot better. I shouldn't say we could have done well. I'm my own worst critic. GTLB. GitLab. Never heard of this one. Let's go to the monthly chart. There's not much data here, but clearly we are breaking out on a monthly time frame. Weekly chart should provide us more data. Big breakout. Here's your volume-weighted moving average. This is your buy signal here. The week before last, the break and close above 60.58 was a buy signal all day long. You got your continuation move up last week. RSI strong, not overbought. Stokes strong. A little overbought, but they can remain overbought for a while. All right, so here's where the rubber meets the road. Would I buy the shares here? No. Why? Automated trend lines, man. All right, we have been attempting to break out above this resistance level. We probably will, but we want to trade the market that we have, not the one that we want. So what we want is for GitLab to close. What's this price? $70.13. It's rising, so that's going to change day to day. So adjust your entry point accordingly. So if you have TrendSpider, make sure you have an alert set up here, please. GTLB daily breakout, strong weekly chart. Breakout, boom, we're good to go. Our alert is set it and forget it. What's the other one? ESTC. A lot of overhead supply here on, this is a daily chart to be fair. Let's step back. I don't know this company. You have a lot of resistance up here. It's attempting to break out. It has stopped going down. It's improving. It's a recovery play. It's been hammered over the head. You're going to have a lot of what I like to call zombies or overhead supply immediately above, very immediately above. So be careful here with your entry point. And if we fail to hold the lows of the month, it becomes a potential short, especially if we break down below the lows of May. Then it becomes a real serious short. Now, weekly time frame, we broke out the week prior to last week, not too good. We're struggling here. I think you need more consolidation, just as you had back here. This was support. It closed down below it yet again last week. So I would say avoid this one. Daily chart. Yeah. Again, the value of the automated trend lines, right? Click of a button. We closed right at support. I would not hope that we're going to hold it. We're probably going to hold it because you're seeing the monthly chart improve, the weekly chart improve, but we don't want to hope. That's not the way we trade. We want to hope. We want to hope that when we buy, it goes up after it breaks out. So we never want to hope that a stock is going to do something at resistance. So we have resistance immediately above. Be careful here. A lot of overhead supply on this stock. I would avoid until it breaks out. And that is it for tonight, folks. Dan Clark, hey, Bob, what are your thoughts on Amazon? BA, we already did. We'll go make Amazon the last one for the evening. Franklin, have an awesome night, my friend. Chat with you tomorrow. I saw your message. You're out west. Where are you out west? Amazon. Retail sales coming out this week. On the month, we're breaking out. We have several trading days left to go. Does it hold it? We don't know. Weekly chart. We broke out last week. Weekly time frame. Amazon looking good. How are the options priced here? Options are fairly priced. You can trade the options or you can trade the common stock. Either one, both look good. They're definitely not expensive. Let's go to a daily chart. We'll leave it off with that. Good consolidation here. Amazon's going to break out. Bullish on Amazon. You're in Tahoe. Oh, yeah, please hit the like button, folks. Thank you. You're in Tahoe. Good for you. Yes, let's have a good week, all. Folks, I want to thank you very much for being here. Please help me out with the YouTube algorithm. Hit the like button. Subscribe to the channel. Again, my 5-part video tutorial below is free on my top 5 favorite candlestick patterns. Take advantage of our 14-day free trial offer. And TrendSpider, 35% discount code below, the cheapest price on the web. Everybody have a profitable trading week and be well.